So you've been wanting to research companies, but you don't necessarily have the time to do it yourself, or you don't know how to do it yourself. In this series of videos, I'm going to be going step by step through my entire process from beginning to end on how I find companies, what I look for when I do my initial research on the companies, if they pass my initial research, how do I value and evaluate them after reading their financial statement. I will go step by step, including valuations when we get to that point, and how to evaluate companies. My name is Jason Rivera, and welcome to Value Investing Journey Case Studies. In today's video, I'm going to do an investment analysis of Ford Motor Companies. Before I get to that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, Spotify, SoundCloud, iTunes, and more. You can get this as part of the I Love Value Investing podcast anywhere in the world for free. To subscribe and hit the notification bell if you're watching on YouTube, so you're notified every time we release a new video, and release new videos all the time. Stock ticker F. Okay, the last set of case study investment analysis videos like this, we've covered US Steel, IBM and its spin-off situation, AT&T, ExxonMobil, and Cody. If you'd like me to look at a stock, let me know in the comments below in this video or in one of our other investment analysis videos. I've already analyzed a stock for Brian, a stock for Cody, and I've got on my list a stock to analyze for Psalm. So if you want me to analyze a stock for you, let me know in the comments below, so I can add it to my calendar. And if you want access to our other videos in this series, the ones I just mentioned, they'll be linked below this. And I may reference some of those videos, especially if we talk about things like debt or impairment or goodwill or intangible assets. I will reference specific videos to watch. So make sure to note that those are below. But today, I'm going to take you through my visual preliminary analysis of Ford, tell you what I see, and tell you why it caught my eye, tell you why it's important. And I need to put a caveat in here before we start. On some of my other videos, I did not put the caveat on here that I'm doing this analysis for educational purposes. I don't own stock in any of the companies I'm talking about personally or in the portfolios I manage, and I don't short sell. So I have no personal vested interest in these companies either way. This is for educational and teaching purposes. Okay, so nothing really catches my eye on here. This a little bit because it's so low, but if you've seen any of the other videos in this series, I don't really care about PE much. But other than that, I don't see nothing really catches my eye on here. So let's go to here. Okay, ratios tab. Revenue, about stagnant the last 10 years. It rose significantly until 2018. Fell in 2019, of course, fell this year because of the coronavirus stuff. And car companies and vehicle companies like Ford are getting absolutely hammered by the coronavirus stuff, which you'll see in pretty much all of its metrics and stuff that we talk about. Operating margin has cratered in the last decade from positive 9.8%, which is almost my threshold that I look for. I look for anything above 10% on a consistent basis. This is actually a high watermark of the last decade in 2010. And this year so far, or in the last 12 months, it's actually negative 4% rounded up. Which means it's unprofitable on an operating basis. It's unprofitable on a net income basis. Oh, actually, let's go back up here. So I skipped over this. $12.6 billion in operating profit in 2010 compared to negative a little bit over $5 billion in operating loss in this period. That's a huge, massive swing in the last decade. That's not a good thing. It's not a good thing when margins fall into unprofitability. It's not a good thing when there's a $17, $18 million swing to the negative side in terms of operating profits. Similar story here, actually hugely net income positive for most of the decade. Again, I don't really care much about that, but it's interesting. $6.6 billion profitability. Net income on 2010, negative 2.1 in the trailing 12-month period. Earnings per share have cratered to negative. It's actually been buying back shares, which is a little bit surprising. Book value per share has risen enormously since 2010. Generally, this is a good sign because this is a very basic level and conservative level valuation. You typically want to see this going up over time, and we'll check on the balance sheet to see if this is a true number when we get to talking about goodwill and intangibles and debt. Free cash flow, stellar free cash flow. ROIC, negative, not good, and a huge drop in ROIC in the last decade. Again, as I mentioned in several other videos, because this is higher than this, I automatically know the company has debt, and in this case, a significant amount of debt, because ROE is levered by debt, while ROIC is not. Again, if you want to learn more about that, go to some of the other previous videos that I talk about that more in depth. This is a huge number because this is so much higher than this. The company had an enormous amount of debt in 2011, probably even more than they have now as a percentage of the company. Free cash flow to sales, very good, surprisingly. I look for anything above 5% on a consistent basis, and it's been above 5% for most of the last decade, which is a bit surprising considering that car industry is just getting hammered right now by the coronavirus. But I can almost guarantee that's due to issuing of debt in the trailing 12 months is why this is positive versus operating profits and net profits being negative. Huge spike in cash in the latest quarter. Again, likely issuing debt to raise more cash. Other long-term assets, we'll see what that is on the balance sheet. Intangibles are showing up as 0 on here. That's most likely not correct. They have a significant amount of debt, both short-term and long-term debt, which we'll see the absolute numbers here in a minute. Debt to equity ratio, I look for anything above or below 1, for kind of a margin of safety perspective. So that's, again, not a good sign when it comes to that. This dropping is interesting over the last decade. As their profitability has gone down, their cash conversion cycle has gone down. That's interesting. Most of the time when profitability goes down, it's because their cash conversion cycle goes up. But so they're selling stuff faster, but they also have more inventory. Not a great thing. But again, it's kind of hard. Cash conversion cycle is very applicable to most of the business of finance, or to most of the business of the car industry, but car industry or car companies also have a large finance division, so it's not necessarily a great indicator here, but it's still interesting that it's fallen so much in the last decade. Okay, back up to here. Let's bring up the financials. Oh, so like when I talked about with U.S. Steel in the U.S. Steel video, this being negative is a terrible sign. This number indicates that based on its current net profits, the company cannot cover its current interest payments on its debt. Anything below 1 indicates that, and this being negative means there's a negative number left over, which is likely another reason, or which is why another reason why it's had to issue debt in this period, not only due to the revenue and profitability declines, but also to service its debt as well. Because when this happens, companies in danger of going bankrupt unless it issues more debt or issues more shares, which again, I talk about more in the U.S. Steel video linked below. And I don't know why that the equity is so much higher here than it is on the other page. It should be coming from the same data source, so I'm not sure which one is the true number, but they're both frankly above my threshold, so it doesn't matter much. Okay. Oh, so they have, what's their market cap? Ew. So they have $175.2 billion in total debt versus a market cap of $31.5 billion. That is horrific. And to illustrate that, even after you subtract all the cash and cash equivalents, you're left over with about 112 off the top of my head, $1 billion in net debt, which is still 4 or 5 times higher than its market cap. This amount of debt is frankly absurd, absurdly bad in a bad way. I'm at a little bit of a loss of words here Let's see most indebted companies in the world. Volkswagen, number one. We already talked about AT&T and why to stay away from AT&T. They're number two. Ford is, 1, 2, 3, 4, 5, 6, seventh most indebted company in the world as of July 2020. The amount of debt it has, again, is absurd. To illustrate that, and again, I talked about this in I think the Cody video and the Exxon video, is I don't even have to go to the balance sheet, which I will, to point out anything else that kind of catches my eye. But I don't even have to go to the balance sheet to show you how horrific this is. So it has about, again, 100, no, that's not 112, that's 120-ish. Let's just round up, say $120 billion in net debt after subtracting its cash. So when you subtract its equity, which again is the book value of the company, the kind of very basic underlying value of the company, from its net debt, you're left over with a number of negative $90 billion approximately, which means based on just the book value, just on the balance sheet, the shares you're buying on the market are worth negative $90 billion, which essentially means the company shares that you're buying on the stock market are worthless. In a real world sense, that's not how it always plays out, because of course this doesn't include the operations. But with its operations being unprofitable, when not accounting for its debt issuances, does its operations in kind of quote unquote normal times make up enough for that $90 billion negative number to make this company shares even close to worth buying? I'm going to guess no. But let's go through here and find out, because that's, I think, probably off the top of my head, the worst number I've ever seen in terms of net equity or negative equity when going through the things I just went through. And frankly, it's even worse than that, because they're not even showing their intangible assets on here. I don't know why Morningstar's not bringing this data in, but I can guarantee you that yes, while this does have some value, again, which I talk about in the Cody and ExxonMobil videos, I would discount this by an enormous amount. Again, if you want to understand why, go to those videos for more than an in-depth explanation. But that brings the negative equity and negative book value into even further negative territory, putting it well over $100 billion in negative equity. And the debt is just absurd, just going through it. So this, by my estimation, just off the top of my head, kind of a proverbial back of the envelope calculation here, this would probably be negative 120 billion in equity after making all the adjustments that I was talking about above for the debt minus the cash and the adjustments to the intangible assets and goodwill as well, which again aren't showing up on here, so I can't give you an exact number, but probably negative 120 billion in negative net equity, which is, again, off the top of my head, the worst I've ever seen. And I've evaluated companies for 14 years, in thousands of companies all over the world, probably thousands, tens of thousands at this point, of stocks all over the world. Off the top of my head, that's the worst. Horrifically bad. I frankly don't even know how to put that into words in a short video like this, how bad that is, other than essentially that means it's negative $120 billion in net equity for the shares. That means for the shares to have any value. I'm just going to go through the cash flow statement. I'm going to scan through this, see if there's anything that catches my eye. That's interesting. I'd want to know what that, in the last 12 months, what they've purchased for $30 billion almost. Same thing here, same thing here. And here's where we get to the actual debt. So what this means in the last 12 months is that they've issued actually the number's right here, I don't even think about it, $21.6 billion in net debt they've issued after considering issuances and debt payments. So again, that's essentially how they're surviving right now during this pandemic, is by issuing more debt. And they're the seventh most indebted company in the world. That's not a good combination of things going on at Ford. So having said all of this, let's see its valuation. And its valuation is absurd. On an EV, enterprise value to EBIT level, I look for anything below 8. This is 351.1. The reason I love EV to EBIT instead of PE or price to cash flow or price to forward earnings is because those numbers do not include cash and debt. And since 99% of companies in the world have debt and cash, I want to know what that is, as thinking as a total business owner, which is how I think about before I invest in a stock. So when you consider its enterprise value to its operating profits, this number is absurdly high. Again, I look for anything below 8, and it's 351. So there's at least in terms of the balance sheet and the financials and the cash flow statement, there's no really redeeming qualities to Ford right now. Frankly, not even a little bit, because even its cash flow, free cash flow margin, which we talked about over here, and I guessed was positive largely due to debt issuances, is not even really a true number, because it's positive. We saw in the cash flow statement, it's positive largely because of the debt issuances, which isn't a real free cash flow to sales. It's manipulation isn't the right word, but it's not free cash flow from operations. This is free cash flow total, but free cash flow from operations. Typically in a health company, they wouldn't have to issue debt to have positive free cash flow. So I hope this helps. Hope you can learn a lot. Love to hear your thoughts on this stock below. Do you have any thoughts on Ford? Did I miss something? Did I not explain something well enough? Let me know in the comments below. If you want me to evaluate a stock for you anywhere in the world, let me know. The only stocks I will not evaluate are banks and insurance companies. Banks I don't evaluate because they're not my circle of competence, and insurance companies take longer to evaluate because you actually have to dig in the financials on a preliminary basis. The financial reports, sorry, not the numbers we're looking at here. So if you're watching on YouTube, make sure to like, love, share, subscribe, comment, hit the notification bell so you're notified every time we release a new video, and release new videos all the time. If you're listening on YouTube, or if you're listening on the podcast, sorry, like, love, share, subscribe, comment, download, all that good stuff, and really appreciate a review, because the more reviews, views, and downloads we get on our content, the more people we can help. If you're looking for some free resources on how to become a better value investor and how to evaluate stocks better, you can get those below. There's 5 free gifts, including my evaluation and analysis templates that you can get for free. As part of the 5 free gifts, you can get the 7 tips guide to picking great stocks and the 3 times you must sell. And you can also get a free PDF copy of my book, How to Value Invest, at the links below in the description. If you're looking for more personalized help and maybe to take a course on to learn how to value and evaluate stocks faster, better, and more efficiently, check out our masterclass, which also has a link below in the description as well. But until next time, have a great day. Talk soon.